I'm Ben Summers, and welcome to the Shadow Banker Secrets podcast, based on the book I wrote by the same name. Today I'm joined by my good friend and colleague, Stephan Moscano. Stephan, it's good to see you. As you know, we have often talked about my firm and what we do and how we're always looking for new asset managers who can generate objectively better performance than what's otherwise available. So I thought it would, and again, we talk about that a lot in theory, right? But I thought today would be a good opportunity to talk about specific examples of what it's like to go through the process of becoming an asset manager, trying to scale, what distribution and capital raising looks like. And there really is nobody who's better to talk to than you about that, right? You've got over 2 million investors in your network. You've run one of the most elegant real estate strategies I've seen. I think, correct me if I'm wrong, but you are the largest owner of owner-financed residential property in the United States. So you've killed it on both the asset management side and on the capital raising side. So yeah, Stephan, again, it's good to see you.
Thank you for having me, Ben, first of all. And we're technically, I don't know this for a fact because they don't really keep this stat anywhere, but what I always say is I believe that we're the largest buyer of owner-financed income-producing properties in the United States. And that probably entails all that, but it's just not a very common strategy. But no, thank you for having me. There's a lot of fluctuation going on in the markets right now, obviously. And even since the last time I talked with you back in March, the world has changed, the financial markets have changed. And so it was really important to me to try to sit down with you and talk about things that I've learned, things that I'm executing on right now. And it's funny that you refer to me as an asset manager because that is technically what I am, but I never really thought of myself, I guess, as that. I just thought of myself as an investor, and I guess you could call it ignorance is bliss, because it's really been a blessing. Everything that's happened with what we've done over the last 15, 20 years now has happened organically. And that goes on the investing side, both from learning things out of necessity as the market changes and evolves, and on growing the network to where today is, as you kind of mentioned there, I own the largest real estate group on LinkedIn, and between the groups on LinkedIn and our opt-in email database, we've got about 2.5 million members all told of investors and agents and all that. And that happens because, and we haven't even talked about this much, but where that all came to be was for me trying to learn how to drive traffic for a website that I had created back in 2012 called listedby.com. And if that website had worked out, I'd be a billionaire and I wouldn't be talking to you right now. But, the thing that did work out from that was it taught me about marketing, driving traffic. And I feel like all of the lessons I've learned over the last 15, 20 years have culminated, piggybacked off of each other in a sincere, natural way to get us to the point where we're at now, to where all those things can be utilized properly. And one of the things I know that I talk a lot about with members of my network, investor partners that I have, friends, family, and that you preach as well, is that you want to be prepared as the market shifts to capitalize on those swings. Because if a market's flat, in my opinion, there's no opportunity there. If a market continues to just always rise, that's fine. Rising tide floats all boats. But it's really these fluctuations, these wild, chaotic ups and downs that create the opportunity for the most informed investors. And so that's something that I preach to my following, and that we want to be ready to capitalize whenever an opportunity strikes. I know you feel the same way. So I'm excited to kick around some of the things that have worked for both of us and see how they connect together. And I know, just from talking with you on a personal level, I know we've got some things that we have disagreements on as well that we can kick around, things that I've learned from you, things that I've done on my own, and see how it all connects.
Well, I wouldn't say they're disagreements. I'd just say maybe it's a difference in priority, right? And so that's why I thought it was a really good idea to have this discussion today in particular, right? Because I think a lot of asset managers, and again, we're asset class agnostic. We're going where the best risk-adjusted performance is. The fact that, Stephan, you're in real estate is incidental. It's coincidental. It's not. We're not working together because you're in real estate, right? So what I think is really worth exploring is we know that your strategy is very good intuitively. And we even have some preliminary quantitative metrics to communicate that, specifically looking at drawdown, right? You don't have any. So, right? Right. So what I found initially fascinating was like, look, you can't just buy real estate in all phases of the market and make money. Because if you're just going to buy it, market forces, comparable sales values, are going to force you to pay whatever that market value is, maybe some slight discount. But when the market goes down, you're going to take a hit. But you lived through that and did really, really well with an acquisition strategy that's arguably over-levered. So how are you able to maintain those very high returns despite what seems like a counterintuitive approach?
No, and it's really well, and I wouldn't even say it's arguably. I'd say it's definitively over-levered, to be honest with you. But, you know, I'll say two things on that. Number one, that's one of the things I'm most thankful for about our friendship. And what I've learned from you, honestly, is to be able to properly evaluate my investments as an, not only for myself, but for everybody in my network too. But because again, it's kind of been an ignorance is bliss kind of thing for me, to where I just looked at the end result was good. Okay, great. And obviously you learn things from mentors, and from your own experiences as you go. But working with you and learning about your risk analytics, your process that you go through with, and finding out that, I believe, you can correct me if I'm wrong or make me sad if I'm wrong, but I think we would pass the test from our discussions. So that's been fantastic, and that's evolved and expanded my way of thought process as an investor, to where I feel like we're more capitalized now in 2022 than we ever have been to capitalize on these markets. As far as the strategy goes, my personal strategy, and you touched on why that's worked, even when it might not feel like it should in an orthodox setting. That's where the seller financing comes in. And we kind of talked about this offline the other day, kind of kicking it around a little bit. There's a human being element that's hard to scale, hard to quantify, that when you're buying properties with seller financing, it creates opportunity that normally wouldn't be there if you were getting bank financing or if you're buying cash. And I saw that a lot, during the last market crisis that we had, to where if I'm buying a property, right? So I always look at the cash on cash return personally. So how much money I'm putting as my down payment, how much net income that property is generating to me, and then that's all that matters. The purchase price becomes not only secondary, it becomes literally the thing I care about the least, because all I'm looking at is leverage to, as you said, you could even make an argument over leveraged to create that high cash on cash return. And as he said, if the market crashes, that could be a problem, except for what we saw during the last market crash, and what it looks like we're seeing today, even more so. We have some of the stats that we were talking about the other day. When market values dipped by, in some cases, 60, 70%, rental rates actually went up because in some cases, because you had former homeowners that unfortunately were foreclosed on, that were now influxed in the rental market. Today, with the, I don't know if we're millennials or Gen Xers or Cs or Ys or Ks or where we're up to now, but the new generation is in some cases prone to renting more than buying. So it's even actually more strong today than it was then. So I've always created the property, not like a property where I'm a slave to the market fluctuation in the values of the homes or the condos, whatever it may be, buildings, but as a cash machine, to use those properties as a way to create consistent income. That's number one piece that I know that you agree with and have had a lot of success with as well. The secondary piece is where the seller financing comes in, is because you're dealing with a human being instead of a bank. For me, at least, this is how it's gone. And, we got a 20-year track record now of doing this. If the market crashes, like it did really when I started this process, because I've got a person that I'm dealing with instead of a bank, I can now and I'm building the relationship with that person. You're making positive payments. You're getting to know them on a human being level. If the market tanks and the balloon payment's coming up, let's say I owe, $500,000 on a property with a seller finance note, and I've got a balloon payment that's due in a year. The human being that is my lien holder, they are seeing the same things in the news that I'm seeing. They know what's going on. They know me. They know the story. They know the back track record that I have with them. I can call them up with a simple discussion, and I can ask them to negotiate an extension. Or if I'm going to have to pay them off, they likely don't want the property back because they're going to deal with the same issues that I'm dealing with if they try to sell it. I can negotiate a principal reduction on that payoff. And that goes for the same in booming markets like we've seen the last 8-9 years here as well, to where on my seller finance deals, a lot of times we'll pay a premium on the purchase price to get favorable terms, low interest rate, interest only amortization, and a lower down to create that leverage and the high cash and cash return. But a lot of times we'll make up that premium that we paid on the front end, on the back end, by going to them and saying, hey, if I cash you out early, will you take a discount? And it's shocking how often that they say yes. And so that's the element of the owner financing strategy that's hard to quantify, because obviously it's up to what the human being does. But I believe in a fluctuating market, in a chaotic market, it's best to give yourself the most opportunity to adjust to the swings, and to give the one thing you're guaranteeing yourself is that you can at least have that discussion and you can at least ask the question. And that's something that you could never guarantee yourself with a bank, because you'd be dealing with a customer service representative that's some 21-year-old kid reading a script that doesn't have any authority to negotiate with you and doesn't care. So that's my long-winded ramble answer to the strategy.
That's perfect, right? So I guess that leads to the next question. I hear a lot, the sort of Grant Cardone syndrome is, don't worry about the purchase price. Don't worry about the value. We've got income. And to be clear, you are focused on the income, but you are protecting yourself, or you are protected by virtue of, again, dealing with a person instead of a bank, and having a reliable expectation that some substantial percentage of your lien holders are willing to accept a discounted payoff. So you're negotiating a discount. You're just doing it on the back end to the paper, as opposed to the front end with acquisition price.
No, and that's one of the things that I'm thankful about with you, Ben. Obviously, to date, when we originally met each other, I was doing marketing for a different investment fund, and they brought you in as a compliance expert. And so we kind of developed a mutual respect, I think, and friendship there. But in working with you in a formal capacity to date, it's really only been on the marketing side, with me kind of introducing some of the opportunities there. And that's what I was excited with you to kind of take that relationship deeper with me as an asset manager, with a strategy that, fundamentally, I've always looked at it from a common sense standpoint and said, okay, I feel like this works. The end result's good. But with what you've developed with your, risk adjusted performance calculator, the structure that you have to properly vet any investment strategy, whether it's mine or someone else's, you can take what you think is true and then know it's true definitively because the numbers say it is. And I know we're kind of starting that process now, and I'm excited about that because it adds an extra layer, not only of credibility for me as an asset manager, but it also it may or may not change the way that we evaluate the things that I'm investing in, right? Because I want to make sure it hits that metric. And I know, okay, well, I did really good in this time period, but I could have done a little bit better if I was looking at this aspect or this aspect here. So, anyway, that's my perspective on it. As an asset manager, can you, for those that don't know, can you just give a brief rundown of what that process entails, and if I'm misstating anything?
No, not at all. I appreciate that. But before I go through the process itself, I want to ask you a question, because I think our relationship to date and our conversation has really sort of planted this question in a lot of people's minds, which is, okay, so Stefan already has over 2 million investors in his network. He already has a strategy what the fuck does he need Ben and Adagio for, right?
Well, and I wouldn't say that it's a need. I'd say it's a desire. I'd say it's a desire to always look at better opportunities and how you can be better, right? Because, um, you know, I mean, perfect example. And I ramble about 2008 so much. I told you I wasn't going to mention it today, but I'm going to because during that last market cycle, I earned 32%. You earned 41%, right? And that's not, you know, I'm kind of joking there because, you know, decimals is not, but it's always looking to be better and improve and adjust to make sure that you can continuously stay on top. I mean, I had mentors in real estate back in 06, 07 that were worth 50, $60 million at the peak. And then they went bankrupt. And they had been, you know, one in particular that was one of my first, you know, probably my main mentor that taught me how to calculate a cash on cash return. And he was, you know, kind of decimated by the last crash. And he had success before that for 40 years. And I don't ever want to be in that position. So, and I don't want any of my partners, investors, clients to ever be in that position. So I'm always looking for ways to be better, ways to be smarter, more engaged. Now, anybody, and I've told you this seriously and in a joking way, I only understand 40% of what you say, right? Because anyone can hear you talk for 10 minutes, understand that you're extraordinarily intelligent. When you look at your track record, the numbers that you have, and then more importantly for me, we share a common desire, I think, that we've talked about a lot, to kind of provide opportunities to the everyday investor that they normally don't get access to. That's been, you know, the fundamental principle for me with everything I do, and I know it is for you as well. So it was the combination of us connecting on a philosophical standpoint with your track record, with the desire to see if there's a better way to do things that led me to want to engage with you. And then as I've learned things. You know, I've learned what GP stakes investing is. You know, I've learned how to better analyze my investments for myself personally and for my partners as well. So that's my long-winded.
No, I certainly appreciate that. Correct me if I'm wrong, but I'm going to add a finer point to this and my interpretation of why you are working with us, right? So what I see, raising money is a full-time job. Managing an asset management business is a full-time job. Oh, by the way, running a fund, that's also a full-time job, and that's a third thing you have to do, right? Reporting, administration, operations, managing legal, like that is a non-trivial task. And I think by your own admission, like you're not too keen on spending all day behind the desk, you know, drafting Word docs, right? So, and
anybody who knows me for 10 minutes can tell you that. Yeah.
Right. So you've got the talent and the resources on the marketing and distribution side, and I'm greatly appreciative. I mean, I think you could have pursued a lot more deal flow for your real estate business over the last few years, and you've been gracious enough to forego a lot of those opportunities to work and support us on the marketing front, right? And so it's an opportunity to allocate resources in the most optimal way. So once we get through and verify the risk-adjusted performance of your strategy as it currently stands, optimize it to the extent that we can and need be, then there's a whole new job that, with all due respect, I don't think you can do, which is the financial engineering to structure the capital stack to build the structured product that securitizes that strategy, bridging the gap between the capital terms that you require and then the capital returns, the capital terms, the investment vehicles in demand within the capital markets. And then the compliance considerations around the distribution. And then the regulatory obligations you have managing the fund. So working with us, we're taking you completely 100% out of the securities issuance business. You no longer have to worry about, hey, am I doing this right or can I get in trouble with the SEC? We're allowing you the opportunity to just, A, focus on your strategy, and then we can integrate your marketing and lead generation efforts in an efficient way that folds into our existing infrastructure. So I think people tend to oversimplify what it means to be an asset manager, especially if you're kind of a one-man shop. There are effectively 3 full-time jobs that at some point have to give. Something has to give. And I don't think a lot of young asset managers and emerging asset managers recognize the depth of work and expertise required in each of those levels.
And that's why they're not successful, honestly. And I'm not trying to be rude, but the people that are, and I've talked, because I own a marketing company, right? And I've have a lot of people trying to raise capital coming to me to do campaigns of all sizes and scales. I meet a lot that they don't understand why they haven't been successful. And I feel bad for them, but it's because they don't have that grasp. And you're 100% right, Ben. I mean, like for me personally, I'm not a paperwork guy. It's not, my brain doesn't work that way. I like deal making. I have the strategy, and on the marketing side, I love, the concept and the execution of communicating with people that are like-minded and giving them resources. And I love all of that. Compliance, it's not my expertise. So, for me and for anyone really that has an effective strategy, that's great. That's the first step. You're already have been given a gift if you find a strategy that you know how to execute on better than anybody else that works and creates a high return for you and other people. But you will never scale that to the extent that you could if you don't know how to do it in a compliant fashion, number one. And even if you did, like you said, the time aspect of that is so draining. Each one of those things, I think it's really 4 or 5 things, really. I mean, in my aspect, you didn't even mention property management, dealing with, broken toilets or, angry guests, if it's a vacation rental or tenants, whatever it may be.
Well, that's part of asset management. That's your business, not mine. But I get your point taken. Yeah, because real estate's not sitting behind a Bloomberg. It's an operationally intensive job, right? Like you're running a business. It's not just trading securities behind a Bloomberg. So right, like you've got the property management and everything else. So not to interrupt, but still from my perspective, that falls under the domain of asset management. But point taken. Yeah, more than one person to run a real estate strategy.
I'm glad you did point that out, because that's a perfect example, of the terminology. And that's what I'm so thankful for with, hopefully the road we're going to go down on in that aspect is I don't even have to think about that stuff. It allows me the opportunity. And I think this is important for anybody that's an asset manager, and you have whatever asset class you're in, whether it's real estate, stocks, precious metals. I know you hate crypto, but if there was a crypto would never pass your, never mind. But anything that would pass your test, the risk adjusted performance analysis that comes into that, we get to focus on what we love to do, because anybody doing this, you should love what you're doing, right? Otherwise you should be doing something else. And what we're good at doing, and get that success for ourselves, and get that success and prosperity for the people that put their trust and faith in us. And then the things that we're not good at, or that we don't have the time to do, you've developed the infrastructure to where it's kind of turnkey, right? To some extent, we can just piggyback on what you've already built and the work that you put in so that we can operate.
Yeah, no, yeah, that's a really good point. And that kind of dovetails into me having the opportunity to answer the question that you originally asked that I kind of skirted, which is, what's the process look like? On a sidebar about crypto, like if there were a VIX in crypto, I'd buy that all day long, but you can keep the rest of it. Anyway, in terms of the process, so like we discussed, the first thing we have to do is make sure that the strategy is objectively better than what's otherwise available, meaning that we're going to look at its performance across a minimum of one complete market cycle, January 2007 or earlier. And then we're going to measure its performance. We're going to look at all 4 statistical moments: mean, variance, skewness, and kurtosis. And then we have, at that point, an accurate and complete picture of the quality of that strategy. And most of the time, that's not good enough. We'll have to go back and optimize it. Oftentimes, we have to take people who, as I mentioned earlier, they may be acquiring assets at a market value, and we'll have to rotate them into a lending strategy so they can control their basis, so they're not overexposed during market peaks. But again, as long as the risk-adjusted performance is competitive, as accurately measured, we have no bias or affinity to any asset class. We want to generate the highest performance, the best performance we can. Private equity, hedge funds if they can do it, real estate of course, synthetic risk transfer, private credit, you name it, we don't care. The only three variables that matter in investing are risk as accurately measured, return, and liquidity. When can I get my money back? Everything else is irrelevant. So we spend a lot of time and a lot of effort in that phase one of measuring the risk-adjusted performance. If you don't have a track record that goes back to January 2007 or earlier, then we can construct a theoretical track record. You can think of it as a pro forma in retrospect. So instead of starting a pro forma today and guessing about what the future numbers would be, you start that pro forma in January 2007 and you plug actual data into that model based upon the rules that are defined and govern your investment model. Now you do the research, you plug in the historical market data into those variables, and then that model will compile periodic total returns. And the interval of the data being analyzed has to correspond to the liquidity of the strategy, or at least closely. So if it's a liquid strategy, if you're an equities trader, for example, then we'll look at monthly data. By definition, you can, of course, trade a liquid asset daily. But we have sufficient number of data points if we're looking at monthly total returns starting in January 2007 or earlier. If it's an illiquid strategy like private equity or real estate, synthetic risk transfer, then it's sufficient to look at annual data. Again, total returns, change in value plus income, going back to January 2007 or earlier. So we get that again from that pro forma in retrospect, theoretical track record, call it a back test. But we're running it as the third party, the underwriter, for the purposes of gaining accurate insight, not to create a story. And so once we have that insight, then we move to phase two, which is the financial engineering, where we design the fund, we design the structured product that bridges the gap between the terms of capital you require for your strategy and the terms of capital in demand, the investment vehicles in demand.
I don't want to interrupt you, but I mean, so in layman's terms, that's basically when you take the strategy, like in my case, I've got a strategy I feel like is working, it's earning these high returns. And then you package it up to where it's in a format that's compliant, that fits the metrics to where you know it's going to be successul. Is that
It's not just compliance, right? So, I mean, you're a marketing guy, so you should appreciate this as much as anybody, right? Sure. So it doesn't do anybody any good to build something in a vacuum and hope it sells, right? And that's what most people in finance and fund management do. They're like, oh, I'm in real estate. I'm going to get real estate fund docs made just like any other real estate fund manager's docs. And those docs are written to contemplate the needs of the real estate asset manager. There's little to no consideration given to what do people actually want to invest in. Because everybody tends to think in asset class silos. So I just need to go find people who like real estate and they'll give me money. Well, unless they're your good friends, they're not going to give you money. Because they're going to go into non-traded public REITs distributed through independent broker-dealers. They're going to go into public REITs that they can get through any financial advisor. So to look at your fund through the lens of asset class, siloed by asset class, is like saying, hey, I'm going to start a hamburger restaurant and ignore the fact that you've got 18 other restaurants right around you. Oh, they're not hamburgers, but they're pizza. Right? Like, people have to eat. They don't have to eat hamburgers, right? People have to invest. They don't have to invest in your real estate fund. And so what we do is we take a survey of what do the capital markets need from a performance perspective? Do they need fixed income? Do they need equity? What kind of lockup is in demand, right? And then we will engineer the structure the fund to fill the holes, to meet the demand of what the capital markets want to invest in. And oftentimes that's very different than what you want to sell, right? Yeah. And so that's why I say we're a private structured products desk, because we're converting one type of capital stack into a different type of investment vehicle. Like, for example, for the last decade, we were converting what would be naturally an equity issue more times than not into a fixed income product with treasury level risk that generates real yield. So that is a huge undertaking that requires a high level of financial engineering expertise that no asset manager ever thinks about. They just don't think about it. Except for the guys who maybe run synthetic risk transfer type strategies, right? They think about it, but nobody else. So it's not, my point is, it's not just compliance. It's actually a very sophisticated marketing component. It's finding out what the market wants and designing what they've asked for and converting what you want to give them into what they actually are looking to buy.
Well, nicely done, good sir. That was literally the next thing I was going to say, and it just crystallized for me even more now. Is it's not just a compliance aspect; it becomes an additional resource that helps with the capital raise process too. So,
right. So, like, you've got 2.5 million investors, but that doesn't mean they all want to buy a real estate fund.
I mean, just to piggyback on that too. I mean, I'm a great example of that because I have 2.5 million people that are investors, self-identified investors first and foremost in my network. And, you know, I've got maybe 80 investors that have actively invested with me. So obviously you're talking a tiny fraction. And so that's another thing I am excited about is that when you're doing it in a more mathematical way, and you mentioned earlier, you know, it's not about the story. Anybody that's passionate about the fund that they're managing, the strategy that they're promoting, has the story already. You're providing the credibility and the fundamental basis of numbers and math and track record that bring the story into reality. And that's a huge piece that's going to appeal to, in my case, I'm excited. I believe it's going to appeal to a whole different demographic that might not have considered because we didn't have that before. And now hopefully I will, and anybody that goes through your process will have that foundation to be able to present to potential investor partners.
Yeah, and math sounds like this abstract idea, right? Like, Ben's good at math. So what? So what? Well, here's an example of why math is important. You're 70 years old. You have $3 million in the bank. You're leaving your job and retiring for life. What investment yield do you need to survive off of for the rest of your life with that $3 million nest egg? The answer to that question can only be found through math. Now, that's the simplest example, right? But it's a very tangible example. Most people hate math, they hate numbers, but it's got a very real and important application. And that, again, is just one very, very simple example. But taking it further, it's this mathematical wherewithal, again, allows us to convert one type of investment to a different type of investment. It allows us to engineer a structure and make an absolutely reliable dividend, no matter what happens. So if we have another 2008, we can issue fixed income that won't be impaired. Dividends won't be cut if we have another 2008. It's the math that creates that stuff. It's not some sort of like ivory tower abstract thing. It creates very tangible value.
Well, and not only does it, you know, give you that bit, but it gives you, in my opinion, flexibility, right? That's what gives you the ability to move in and out of asset classes in any given market and have that consistency. So back to, you know, why I'm excited to work with you and why I did forego other opportunities. And I mean, I've had when you have 2.5 million people, you have everybody under the sun that wants to work with you in some capacity. The reason that you're the only person I've ever worked with in this structure is not only because of the things we talked about earlier, to where there's things that I simply can't do and or don't want to do that your group provides, but it's because when you look at it in the format that you do and in the framework that you developed, it's simply better end results. And I want better results. I mean, who doesn't? You know, I'm an investor myself, first and foremost. Everybody that puts their trust in me, that's the mindset. We want to get the best possible return. And what you've created, in my opinion, helps provide that.
Indeed. And and taking it one step further, back into the distribution phase. So we talked about utilizing the math to financially engineer the structures, but doing it with an understanding of market demand. Now the distribution effort becomes a whole lot easier because now you've just built what people actually want. So now you don't have to convince people, right? You just have to let people know that what they're asking for, you've got.
We got it.
That's right. So it takes even someone like yourself, and correct me if I'm speaking out of turn, who does have this tremendous marketing infrastructure, but now we can use it, we can leverage it in a much more efficient way that allows us to give it what it's looking for instead of trying to force a one-trick pony down its throat.
No, without a doubt, it's a more profound way, and the timing helps too. I mean, this would have been beneficial if we started doing it in 2017, 2019, or any other time. But I do personally believe that the fact that the markets are doing what they're doing right now, and I joked with you on some of the webinars that we've done. I feel like we're kind of like the guys that owned a warehouse full of hand sanitizer 2 months before the pandemic hit, right? So like the things that we've been talking about, both again, individually and collectively, for 10 plus years are now all happening. I want to be positioned to present that opportunity in the most effective way that makes sense and that's going to be understood and accepted. And it's what the people, at least in my network, the investors want. Yeah, and so, no, I'm thankful that you created an opportunity to present it in a way that has, an extra layer of credibility to it.
And it doesn't stop there either, right? So you obviously have your couple million investors, but then we also have the partnership with Intersection Capital and Oren Claff and Daniel Berger and their group, which are the best in the business. And we've got other partnerships with other firms that take what would be an incredible one-off distribution channel, and we build layer upon layer upon layer that gives us an unprecedented reach in the private capital markets. So
that's a really good point too, and I haven't utilized that for my own stuff, obviously, but yet. But that's a huge piece. I mean, for me personally, everybody that's ever invested with me, they've invested with me. I've been everything A to Z, salesperson, whatever you want to call it, and then manager of that relationship after the fact, which I enjoy doing. I'm thankful to do it. But, the ability to access an actual sales team, and not some sales team, no disrespect, but, a call center in India or something like that. But you're working with literally the best in the business, and you got people like Oren Claff involved in the process and the team that they have. Raising capital that have done billions of dollars of deals, I believe. That's just a huge asset to where you've combined all of these different resources in one spot. I mean, it really makes it pretty turnkey. You almost, all you have to some extent is an idea and an effective track record, and then everything else can be fairly turnkey for you as an asset manager.
That's the intent. Like, we're an investment bank. It's a turnkey solution, right? You come to us and we provide you the blank check to saturate your strategy. Your job is to make sure you just have to have a good enough strategy.
And then scale it and then manage it after the fact in a compliant way.
Yeah, we provide the turnkey solution. You just have to have the strategy and the wherewithal to effectively manage it. We do the rest. And we've alluded to in other conversations, like GP stakes. And I think I've said in passing that our cost of capital is low. We have a really efficient distribution, but this is why, right? Like, you're just one person that we work with, and you've got 2 million investors, right, that we can optimize and make more efficient use of. We've got the Intersection Capital team. We've got others. We've got relationships with other fund of funds and insurance companies and the lot. So when we have the opportunity to buy into asset managers because they can't afford the costs of this process themselves, that's what creates these incredible returns. It's our own efficiencies in distribution and cost of capital that can take a GP stakes position and turn out something that's just unmatched.
Well, let me ask you, Ben, because I mean, and I've said this to you a lot, kind of half jokingly, but not really offline. But I think you've really created kind of an all-star team of followers that believe in you, what you built, what you're doing, including me, and are now a part of the Adagio infrastructure, where you have multiple assets and partners on the marketing side, including myself with the 2 million members. You've got rock star record-setting sales teams like Oren's team, Oren Claff. You've got former Goldman Sachs executives working with you in different capacities. You've got top PR people, you name it, all in one spot. How rare is that? I genuinely don't know the answer to this, but how rare is that from an investment bank standpoint to provide all of those resources from a compliance standpoint, capital raise standpoint, every step of the process from A to Z? How is that standard, or how rare is that to all be available to me as an asset manager?
So there are obviously firms that have greater resources than we do. Goldman Sachs, Morgan Stanley, right? But the difference is, not only the resources that you described, but also the expertise in quantitative finance that I personally have, right? So that exists. And there's one of me on the quant side of Adagio, for example. But Goldman has many of those people, right? The difference is they use all of their vast resources to bet against the public. Adagio is the only firm I'm aware of that has this level of resources and expertise that is focused on aligning with the public, filling the hole of merit in financial services and offering objectively better products and services, because we can't compete on brand name. We have to. And thankfully that opportunity does exist. The big financial firms are, I guess, understandably complacent in their way of doing business. They don't have to do any better for their clients. They don't have to do any better for the public. They're doing quite fine with the approach they're currently using. But the tremendous hole in the market left by the big firms because of their ability to just stick with their approach is where we live. As far as I know, and I'm pretty sure about this, that to your point, there is no other firm with our level of sophistication, our level of resources playing in this space. And while we're not positioned to engage directly with the public, with retail investors, we do have a public charity to take the same insights, resources, and infrastructure that we have and use and make it accessible to retail advisors, small private fund of funds, asset managers trying to find their footing, to try to proliferate this merit-based perspective and approach and help level the playing field.
Well, Ben, again, I thank you for the opportunity to be on this episode. As you know, I think I've been on half dozen or so of your podcasts with you. And this one, honestly, is the most important to me, because I think with everything that's going on right now in 2022 and what we expect and believe, what most of the experts expect and believe is going to happen in 2023, I think it's more important than ever for not only investors to be informed, but for asset managers like myself to be informed as well. And I know and believe that what you've created helps us all do that and be effective in a more powerful and ultimately successful way. So thank you for having me. And I look forward to turning a negative into a positive, like was done in 2008, and turning the fluctuation and chaos that we're seeing into prosperity for everybody that works with me, and hopefully everybody that's in your network as well.
Well, I appreciate you. It's asset managers that are doing the grassroots work, generating the performance that fuels everything we do. And we're grateful to have the opportunity to bring it to the capital markets.